It's really incredible as far as how far these yields have gone lower. Even today we came close to testing to the 2016 low for the U.S. Treasury market.
Right.
And as I've talked for some time this year, we keep having these ongoing carousel of concerns, and you've seen this huge bid for fixed income across the world.
Right, but that bid scares me. I mean, at some point it looks like it's the dot-com mania of the late 90s or something. Some of these numbers are astounding. If the Swiss-German debt went up by 2 percentage points, people would lose 50%. If the German 30-year went up to a 1% yield, people would lose 30%. I mean, at some point, the risks are so one-sided. Why don't you see it that way?
No, listen, I do think there's some risk. I think there's risk in all asset classes, and that's why you basically have diversification. Even in the U.S. market, which is being dragged down by those global negative rates, a 15, 20 basis move up in the 10-year, it wipes out your coupon.
Right.
That said, you have central banks buying across the globe. You have these deflationary trends, poor demographics, and there's a bid there. But on a relative basis, we still see more value in equities. And one thing we've been talking about quite a bit recently, there's a lot of near-term uncertainty, but if you actually have a little bit of a longer time frame and you think about the S&P 500, as of today, we have about 63% of stocks in the S&P 500 with dividend yields above that of the 10-year
Wow.
Treasury yield. And what that means is over the next 10 years, stocks could do nothing, trade sideways for 10 years and just pay that dividend.
But and
they would outperform fixed income, albeit with much more volatility.
Absolutely. But Keith, as you well know, people say if stocks are unchanged, I'll get that performance. But what happens if it's 08, 09 all over again?
Yeah, I think that's a recency bias. I think, every downturn doesn't have to be 2008, 2009. If you think about this bull market, we've had, this is the 19th pullback we've seen of at least 5%. But during that entire time, the market is up over 400%. So listen, every year we have 2 or 3 things that really gets the market nervous. And the reason why we called our theme this year, investing amid a carousel of concerns, is as one concern recedes, another one comes to the forefront. It's that kind of thirst for markets to be worried, because we do have that recency bias of 2008.
Yeah.
In our view, the bull market still deserves the benefit of the doubt. I think this corrective period is normal, but it likely has further to go.